Welcome to this presentation on the emerging mega trends in the economy and markets. We know that the stock markets discount the future. Therefore, those investors who can anticipate the emerging trends and make investment based on that insight will do much better than others. This presentation is to enable you to gain insights into the emerging mega trends in the economy and markets. Let us start with the global economy. During the last 9 years, we had economic turbulence. It started with the global financial meltdown of 2008. Then in 2009, we had the Great Recession, the worst economic catastrophe after the Great Depression of 1930s. Then in 2010, we had the European debt crisis, which again rattled financial markets globally. So there was an extended period of very low economic growth, and international trade was very seriously impacted. In 2013, emerging markets faced a major currency crisis when the American Central Bank Fed announced that they are going to taper the quantitative easing programs. That means they are going to reduce the bond buying. There has been huge selling by foreign portfolio investors in equity and debt markets in emerging markets. So the emerging markets reeled under a currency crisis in 2013, and consequently there was very high inflation and low growth for a couple of years. So we had a long period of turbulence, and in 2016 there was the Brexit. All these impacted global economic growth. So compared to 2003-2008, the 5-year period that saw a global economic boom, 2008-2015 witnessed global economic turbulence. Now it appears that the global economy is poised for a rebound. Of course, there are a lot of risks, there are many unknown factors, but it appears from the macro perspective that the global economy is set for a smart recovery. The US is bouncing back with very strong growth. Unemployment in US is at a very low level of 4.6%. Inflation is at desirable levels. So for the coming several years, US economy is expected to do well. US can again become the engine of global growth. Europe is stable and growing steadily, even though the growth rates are not very high. There are no sovereign debt issues in Europe. There is stability and reasonable growth. Japan is holding on. And in China, they have succeeded in soft landing their economy. The much feared hard landing of the economy in China, with a lot of financial crisis expected in many circles, that has not happened. So China has soft landed. Of course, they are growing at a much lower pace, around the 6 to 6.5%, but there are no signs of a major turbulence from China. So in this favorable global macroeconomic environment, global markets are bullish. Globally, stock markets are bullish. The reason is this very benign global macroeconomic backdrop. Coming to India, there are some major structural changes, mega trends that I would love to dwell at some length. First is the major structural shift in India's politics, which will have far-reaching ramifications for the economy also. The recent elections in India, I'm not just referring to the UP elections. Apart from the UP elections, the elections to local bodies in Maharashtra, Orissa, all these indicate a very clear trend. and India is likely to have political stability for an extended period of time. It is quite possible that the ruling dispensation might have majority not only in the Lok Sabha but also in the Rajya Sabha. This will enable the government to implement difficult reforms, very difficult reforms which are absolutely necessary for the economic growth to pick up in a big way, can be implemented by a government under conditions of political stability. This is a major structural shift as far as the polity is concerned. Coming to India's economy, there is a major trend emerging, a mega trend emerging. Last year, in 2016, we had the demonetization. This year, we are implementing the goods and services tax. The government is encouraging digitization in a big way. The inevitable consequences of all these initiatives is the growth of the organized sector vis-a-vis the unorganized sector. The organized sector, that is the formal sector, will grow at the expense of the unorganized informal sector. The formal sector will gain market share at the expense of the informal sector. The informal sector in India has been thriving all these years due to tax arbitrage. Tax arbitrage has been their unique selling proposition. In the new environment, particularly with the implementation of the goods and services tax arbitrage will disappear, and this will be a major benefit for the organized sector. There are certain industries in which the unorganized informal sector is 50% of the industry. In such industries, the organized sector is set for substantial growth in the coming years. In segments like auto ancillaries, building materials, textiles, etc., the organized sector will be growing at the expense of the unorganized sector. This formalization of the Indian economy is a big trend. It is a mega trend which has huge implications for investors. So investors should be looking into segments like the textiles, building materials, auto ancillaries, etc., where the organized listed players, companies which are listed in the stock market, will be gaining at the expense of the unorganized sector. This is a big trend. Formalization of the Indian economy is an inevitable consequence of the reforms that are being implemented now. This has huge implications for investors. Another major trend is the financialization of savings in India. The structure of India's savings, the structure of gross domestic savings in India is changing, and this change is likely to gather momentum. And what is this change? The structural shift in India's gross domestic savings is the shift away from physical savings towards financial savings. Financial savings presently are around 40% of India's gross domestic savings. This 40% will grow. And within this 40%, banks, NBFCs, insurance, etc., at a major chunk. The capital market, the equity market, and the mutual fund segments have been attracting only a small percentage of the gross domestic savings. It is improving and improving very fast. Presently, we are getting around 4,000 crores of rupees, more than 4,000 crores of rupees through systematic investment plans alone into the equity market. And this is going to explode in a big way going forward. So this is a major shift, a shift from physical savings like gold and real estate in favor of financial savings. So a lot of domestic money is going to come into the equity markets, and this liquidity coupled with the favorable sentiments in the market now is going to keep the markets very, very buoyant. Of course, it has got its own problems also. Unless the supply of good quality stocks increase in the market, well, we will have a situation of too much money chasing too few of stocks, which can keep the valuations at very high levels. And there can be instances of crashes in the market also if that happens. But right now, valuations in the market are not stretched. Of course, historically, the valuations are on the higher side. If you compare the present valuations with the historical valuations, the valuations are on the higher side. If you take the last 15 years, our PE has been around 15.5. That has been the historical last 15-year average. Presently, it is more than 17 times forward earnings. So 17 times forward earnings, 17.5 times forward earnings compared to 15.5 is certainly on the higher side. And therefore, there is all this talk about the risk-reward ratio becoming unfavorable. But personally, I believe that this gush of liquidity that is coming into the markets, plus the favorable sentiments, will keep the valuations on the higher side. Of course, when the PE ratio crosses the 20 mark, one should be concerned. We can take stock of the situation at that point of time and devise the right kind of strategy at that point of time. But right now, the markets are not overvalued. Certainly, markets are not cheap, but they are not overvalued. There are many segments of the market which are undervalued even. So that should be the focus of investors. So in this current context of liquidity keeping the markets buoyant, sentiments favoring further flow of liquidity into the market, what should investors do? Now, if you look at the market, investors will never invest in the market, because in a bullish market, the valuations will appear to be on the higher side. There will be warnings that the markets are overshooting, that the risk-reward ratio is very, very unfavorable, etc. Therefore, investors will be inclined to wait for corrections in the market. But the expected correction may not happen at all. It may not happen at the time investors expect it to happen. Similarly, during a bearish phase, there will be fear in the market, so people will not invest. They expect corrections to happen, further corrections to happen. There will be pundits saying that market will crash further, but that crash also may not happen. So it is very difficult to time the market. Investors should not try to time the markets because it is going to be a futile exercise. We should be investing systematically for the long run. Investors should have a long-term time horizon, minimum of 3 years, preferably 4 years and above. With that kind of a time horizon, systematic investment can be done at any point of time. Any time is a good time for systematic investment. So have a long-term horizon. At any point of corrections, in the present context, we are witnessing a bull market, but there will be corrections. Some corrections will be sharp and swift. Last year, Geojit's consistent strategy has been to buy on dips. We have been telling investors to buy on dips in the markets. So Brexit was a very good buying opportunity. Demonetization in the market correction was a good buying opportunity. The election of Donald Trump as the US president and the market correction that followed was a very good buying opportunity. We believe that the present bull market that we are going through, this is a bull market. The present bull market is going to sustain for an extended period of time. There will be opportunities to buy. When the market corrections will happen, how steep the corrections will be, nobody will be in a position to predict. Based on the mega trends that we discussed, we should have faith in the India growth story. Therefore, have faith in the India growth story, have the courage to invest, keep calm during times of turbulence, have patience. Investment will be handsomely rewarded. Thank you.